Shell posted $6.9 billion in quarterly profit, nearly $1 billion above what analysts expected. On the same day, UK 30-year borrowing costs hit their highest level since 1998, two numbers that should not coexist. The connection runs through the Strait of Hormuz. Iran's closure of the waterway throttled roughly a fifth of global oil supply overnight. That scarcity sent Brent above 100 and held it there, doubling Shell's chemicals and trading earnings to $1.93 billion in a single quarter. BP followed with profit more than doubling to $3.2 billion. Every barrel the war priced up lined the pockets of the oil majors. Every barrel that same war kept expensive hit Britain's import bill, widened the current account deficit, and pushed inflation expectations higher on the gilt curve. The gilt market's reaction was mechanical and immediate. When inflation expectations rise, and a government is already issuing more than £250 billion in bonds this fiscal year, with public debt near 100% of GDP, the price investors' demand for lending long rises fast. The 30-year gilt yield reached 5.76%, a level not seen since the late 1990s. That is not an abstract bond market fluctuation. Every basis point higher on gilt yields increases the government's debt servicing costs in real time and tightens financial conditions economy-wide. The Bank of England held rates at 3.75%, but that decision carried an asterisk. At least 2 MPC members are expected to have backed a hike. Shell and BP shares both fell on the day their earnings rocketed, the market reading a rate hike signal as a tighter funding environment for capital returns, even as profits surged. The contradiction is real. Energy majors are being rewarded for the war's windfall at exactly the moment that windfall is pricing their shareholders into a higher rate world. The condition to watch: if Brent holds above 100 into summer, the 2 or 3 rate hike dissenters inside the MPC become a majority. That is the threshold at which the gilt market moves from pressure to rupture.
The windfall rate squeeze already had Britain's bond market fragile. What amplified the sell-off beyond fundamentals was political signal. As polls opened for local elections across England, Wales, and Scotland, gilt traders were not just pricing inflation. They were pricing the probability that Labour emerges wounded, panicked, and forced to loosen fiscal discipline. The 10-year yield crossed 5% intraday. The 30-year stayed near its Truss-era peaks. Those levels matter because during the 2022 trust crisis, it was long-dated gilts that absorbed the most violent selling. Institutional memory is short in many markets, not in this one. The mechanism investors are tracking is not the election result itself. It is what a loss forces Labour to do afterward. Reports of MPs maneuvering against Keir Starmer ahead of expected heavy losses have already reached bond desks. A weakened prime minister facing demands for higher spending and looser fiscal rules is the scenario bond markets price before it happens, not after. Rachel Reeves' ability to maintain the fiscal framework is the only buffer between current gilt yields and another confidence shock. Markets are betting on whether that buffer survives the night. The counter-signal worth noting: economists at MUFG and Panmure Liberum are not pointing at political risk alone. They are pointing at quantitative tightening. The Bank of England is actively selling gilts onto the open market, an approach no other major central bank took. The Fed lets bonds mature passively. The ECB does the same. The Bank of England is absorbing £250 billion in new issuance. The QT program is estimated to cost the taxpayer £125 billion. Economists are publicly calling for it to slow or stop. That debate did not exist 6 months ago. If local elections deliver results in line with current polling, the political risk premium in gilts may not compress quickly. The verification benchmark: watch the 30-year gilt yield. If it retreats below 5.5% in the next 48 hours, the market is pricing political stabilization. If it holds about 5.7%, the bond vigilantes are not done.
The same oil shock that handed Shell its record quarter is now landing on British households through 2 transmission channels that move at different speeds: retail spending and air travel. JD Sports reported that like-for-like sales fell 2.3% in the first quarter to late April, the company's own management describing growth as muted. The proximate cause is consumer confidence, which is collapsing under the dual weight of a run of war inflation and Labour's employer national insurance hike. But the downstream signal is what matters for equities. JD Sports is not a distressed retailer. It is a bellwether for discretionary spending among younger British consumers. When the king of trainers cuts its profit guidance, it is signaling a broad deterioration in the spending segment that drives high street footfall. Witherspoon's issued another profit warning on the same day. Pound Stretcher is seeking emergency rent cuts across 300 stores to avoid administration. The air travel channel is moving faster. Jet fuel prices have nearly tripled since the Hormuz closure. AirAsia's CEO called it worse than COVID for the industry. 2 million seats have been canceled across May alone, 13,000 individual flights. Spirit Airlines in the United States has already collapsed. The UK is identified by Allianz trade researchers as the most structurally exposed economy to jet fuel shortages because of its high dependency on Gulf transit routes. Budget carriers, whose entire margin model depends on thin fuel costs, are the first to break. If the shortage extends into summer, the cancellation wave moves from budget to mid-tier operators. The connecting thread between retail and aviation is the mortgage market. Average 2-year fixed rates dipped slightly this week to 5.83%, the largest one-month drop in over a year. That move provides some household relief. But if the MPC dissenters get their hike, and the 2 or 3 members already signaling one represents a live risk, that relief reverses within weeks. Homeowners are facing up to a £3,000 annual rise in mortgage costs from current levels if rates move higher. That is the number that determines whether the JD Sports and Wetherspoons warnings are isolated readings or the start of a synchronized consumer retreat. The leaning here tilts toward further deterioration, but the recovery condition is specific. A credible U.S.-Iran ceasefire that brings Brent back below $90 would relieve fuel costs, ease import inflation, and reduce the rate hike pressure at the MPC. Without that signal, watch Brent's 30-day average. If it stays above $100, summer travel cancellations accelerate and MPC dissenters gain votes. The one thing that could make the leaning wrong, a faster-than-expected political resolution that allows oil to fall sharply and UK mortgage rates to follow gilt yields down before the summer booking window closes entirely. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.